The market is currently closed. As of the closing bell on Tuesday, June 23, 2026 at 4 p.m. Eastern Time, Lithium Americas Corp is priced at exactly $4.15 per share on the New York Stock Exchange, representing an intraday decline of 3.49% after opening the session at $4.16 and bouncing within a tight trading window between $4.11 and $4.35 throughout the day. While a casual look at your favorite investing sites might suggest this is just another routine downward slide in a long string of volatile sessions for the critical materials sector, a much deeper and unexpected structural shift is happening under the surface. What the broader retail market does not anticipate right now is how the massive disconnect between local asset construction timelines and federal credit agreements is quietly building a localized supply squeeze that has almost nothing to do with the daily price fluctuations of global raw battery components. This structural mismatch creates an intense friction between what everyday retail participants expect when they look at their trading applications and the actual cold, hard physical reality of domestic natural resource construction. When looking at the general narrative surrounding this specific miner, the prevailing common ground among everyday asset allocators is a sense of prolonged exhaustion. Most retail participants look at the wider electric vehicle supply chain, perhaps observing the flattening growth trajectories of companies like Tesla stock, and they immediately assume that early-stage resource suppliers are dead weight. There is a widespread belief that because global spot prices for refined lithium chemicals have remained soft compared to their historic absolute highs, any operation still stuck in the build phase is an automatic cash drain. People look at the massive capital expenditures required to pull lithium out of Nevada clay, and they assume the risk is simply too high to justify stepping away from mega-cap technology favorites like Apple stock or Nvidia stock. It is easy to understand why this perspective dominates the internet message boards and online investment forums, as traditional equity valuations do not favor pre-revenue miners during periods of elevated interest rates and global macroeconomic adjustments. However, challenging that common belief requires stepping away from the generalized index trends and looking directly at institutional positioning and defensive supply arrangements. The reality of domestic raw material security completely upends the simplistic view that low current commodity prices equal zero fundamental value. The federal government has committed billions in conditional credit facilities to ensure that this specific asset reaches commercial viability, regardless of where short-term market cycles move. Major global automotive manufacturers have already locked up massive multi-year offtake agreements, effectively anchoring the long-term revenue potential before a single ounce of commercial material is even processed at scale. While retail traders are busy selling their positions out of sheer boredom, massive global syndicates and sovereign wealth funds are evaluating these assets on a multi-decade horizon. This creates a fascinating contradiction where short-term retail sentiment is incredibly bearish, while long-term institutional structural backing has never been more locked in. If we look closely at the recent price action and daily swings, the technical setup reveals a prolonged consolidation pattern that is testing the patience of even the most hardened market veterans. Trading volumes have fluctuated significantly over the last few weeks, showing clear signs of institutional accumulation hidden behind automated high-frequency algorithms that suppress any major upward breakouts. Whenever the asset attempts to reclaim higher technical support zones, large block orders appear on the order book to flatten the momentum, allowing patient buyers to absorb floating retail inventory at compressed valuations. This specific trading behavior is quite common in the small-cap resource sector, where larger funds use broader market weakness to build substantial positions without alerting the wider trading community. Retail allocators using platforms like a standard individual brokerage or the Robinhood app often misinterpret this lack of immediate upward momentum as a sign of fundamental weakness, when it is frequently a symptom of structural accumulation by deeper pockets. Macroeconomic pressures have also played an outsized role in shaping the current trading environment for domestic mining operations. Elevated global interest rates have changed the cost of capital calculations for capital-intensive projects across the board, forcing developers to lean heavily on strategic partnerships and government credit lines rather than traditional debt markets. This environment has naturally triggered a flight to safety, with billions of dollars flowing out of speculative small-cap names and into large-cap options or stable instruments like Fidelity mutual funds and Fidelity ETFs. For self-investing individuals who manage their own portfolios, the temptation to abandon high-risk development plays in favor of immediate yield or massive tech companies is incredibly strong. When you open a platform like SoFi Invest or browse through Schwab Intelligent Portfolios, the automated algorithms naturally steer capital toward liquid, cash-generating giants rather than long-horizon industrial infrastructure projects, which further starves names like Lithium Americas Corp of consistent retail liquidity. Understanding the trading mechanics of this asset requires analyzing how different retail ecosystems interact with volatile small-cap entities. Investors using basic modern trading software like the Robinhood stock trading platform or the Robinhood app often focus heavily on short-term momentum indicators, fractional shares, and rapid options trading, which can cause massive artificial spikes and subsequent crashes purely on social media trends. On the other side of the spectrum, long-term capital pools operating via Fidelity Investments, Fidelity brokerage accounts, or dedicated interactive brokers trading platforms tend to execute trades with a much longer time horizon, using complex limit orders and algorithmic execution paths. These distinct trading styles create a highly fragmented shareholder base, where short-term panic frequently clashes with long-term institutional execution, leading to the dramatic daily swings and high implied volatility that define the stock's current market profile. Let us transition into what this enterprise actually does and how its core operational model functions away from the noise of the ticker tape. The company is entirely focused on developing the Thacker Pass project in northwestern Nevada, which represents one of the largest known sedimentary lithium resources on the planet. Unlike traditional brine operations in South America or hard rock spodumene mines in Australia, this operation relies on extracting lithium from unique clay formations. The business model is structured around a two-phase development plan designed to scale processing capacity over time, utilizing a proprietary acid leaching process to separate the critical minerals from the host clay. Because this asset is situated entirely within domestic borders, it holds a unique position in the supply architecture, serving as a cornerstone for the regional extraction initiatives that aim to reduce dependence on international processing networks. Past performance metrics and older corporate updates show a history of capital restructuring, including the critical separation of its Argentine assets to isolate the Nevada project as a pure-play domestic development opportunity. The reliance on strategic alliances is central to understanding how this pre-revenue operation intends to survive the expensive construction bridge. A massive multi-million-dollar equity investment and offtake agreement from a major domestic automotive manufacturer provides the essential foundational liquidity needed to advance construction while traditional debt avenues remain restricted. This relationship ensures that once Phase 1 production begins, a massive portion of the output already has a guaranteed buyer at pricing formulas tied to market conditions, protecting the enterprise from being completely at the mercy of open market spot fluctuations. For individuals utilizing self-investing strategies through an interactive broker's account or exploring specialized automated vehicles like an intelligent portfolio, tracking these corporate milestones and counterparty agreements are far more critical than analyzing standard backward-looking price-to-earnings ratios, which are non-existent for an enterprise in this specific stage of development. Looking ahead toward the future outlook, several distinct scenarios could unfold as the company moves closer to its projected production milestones. The most optimistic path involves smooth construction execution at the Nevada site, timely drawdowns of federal credit facilities, and a macro recovery in global battery chemical demand that lifts the valuation of all regional resource assets. In this scenario, the current compressed share price of $4.15 would be viewed in hindsight as an extraordinary structural discount, rewarding patient allocators who ignored the short-term noise on their Robinhood investments or SoFi investing dashboards. If the enterprise can successfully transition from an expensive construction project into an active processing plant, the re-rating potential could be substantial, transforming it from a speculative trading vehicle into an institutional-grade industrial asset. Conversely, the downside risks are entirely tied to execution delays, capital cost overruns, and prolonged stagnation in global commodity pricing. Large-scale mining projects are notoriously complex, and any unexpected logistical bottlenecks, environmental challenges, or technical processing difficulties could delay the first production timeline and force the company to seek additional dilutive equity financing. Such an outcome would heavily penalize current shareholders and create severe friction on traditional self-investing platforms, where capital preservation is a core objective. Furthermore, if international suppliers flood the market with low-cost material, domestic processing might face structural headwinds, despite government protections and regional tariffs, creating a challenging environment for those holding the stock across various retail accounts, from Fidelity IRAs to standard active trading brokerages. Comment below how many shares of Lithium Americas Corp you currently hold, or if you are entirely avoiding the lithium sector right now in favor of tech. When evaluating how to manage a speculative asset like this within a broader portfolio strategy, the choices made by self-directed market participants vary wildly based on their choice of platform and tools. An allocator using interactive brokers platform tools might hedge their underlying equity positions with complex option structures to mitigate downside risk during the long construction phase, paying close attention to interactive brokers' fees and margin rates.
Meanwhile, a more passive investor might rely on the automated balancing of a SoFi robo-advisor or a hands-off intelligent portfolio to manage their exposure to the wider material sector without trying to time the exact bottom of an individual asset cycle. This divergence in execution highlights how important it is to align your specific investment vehicle with your personal tolerance for asset volatility and extended development timelines. The ongoing structural changes in how retail investors access the markets have completely transformed the liquidity profile of small-cap miners. The widespread adoption of features like Robinhood fractional shares and Robinhood cash management has democratized access to the equity markets, allowing smaller accounts to participate in high-risk, high-reward development stories that were once the exclusive domain of institutional private equity. However, this accessibility also introduces a high degree of emotional trading volume, which can detach a stock's market value from its underlying asset value for months at a time. This is exactly where the tension between expectation and reality manifests most clearly, as retail buyers expecting immediate gratification via their Fidelity mobile app run headfirst into the reality of industrial development project timelines that are